Woo! Good morning. Hey, we are small but mighty. We can do better than that. Good morning.
Good morning.
Much better, much better, much better. I'm Russell Marsan, Senior Vice President with Investment Property Exchange Services. We're the largest qualified intermediary in the nation. That's all we do is 1031 exchanges. I've been doing exchanges for 29 years. I am your personal 1031 guru resource, right, for you and your clients. We are together today for only an hour. That's it. It's pretty quick. Let me be very clear. You don't need to remember a single word that I say. What is the one thing that you actually do need to remember?
Your phone number.
Thank you very much. My contact information, it's right there. Write that down. That is my cell phone number, right? So you can reach me anywhere, anytime at that cell phone number. If you call me at like 7 o'clock on a Friday night, the first thing you don't have to say is, Russell, oh, I'm so sorry for bugging you at 7 o'clock on a Friday night. You're not bugging me. I'm a tax nerd. I'm a geek. I don't have a life. Right? You'll be giving me a life by simply calling me and asking me tax questions. Right? My Friday night's a big bucket of popcorn on the dining room table. My phone's right next to it. I'm eating popcorn, waiting for your call. I also teach
I'm bored, I can call.
Yeah, 100%. Yeah. Say, hey, let's do some calculations, Russ. Let's run some numbers. Oh, whoo. Yeah. So I also teach accredited courses for CPAs and attorneys. So I'm a free resource for your clients' legal and tax advisors as well. Another thing I offer, which you might think, like, you had a great space here, I do evening classes for your clients. Right, so you guys should maybe talk to management and say, hey, let's do a client appreciation night for our clients, you know, how to build wealth with the 1031 exchange, right? Like 6 to 7:30 at night, something like that on a midweek, Tuesday, Wednesday, Thursday night. A lot of fun. I never get out of those things until at least an hour after it's over because there's just so much engagement. The clients have no idea what they can do, right? So just, yeah, a lot of things. So 1031 exchange, it's the greatest wealth building tool in the entire Internal Revenue Code because it allows an investor to reposition their real estate assets throughout the course of their entire life without having to pay tax. Right? Because as they grow in life, their financial objectives are absolutely going to change. When they're young, they're trying to build wealth. Okay, well then you should buy properties that are primarily designated for appreciation. Right? Later on in life, maybe you own a bunch of single-family rental properties and you own them free and clear while you're ready to retire. Well, now you need to position to cash flow to maximize your income. Or maybe you get tired of the headaches of owning real estate when you're older as well. You need to go passive. Those are all different financial objectives. Right? And as your objectives change, the 1031 allows you to pivot to that type of real estate that better suits your current financial objectives without having to pay tax. I'm going to give you a series of questions throughout the course of our hour together today to ask clients. Right? Here's one. This is a simple one. If you are listing a property that is not their primary residence, then you should ask them, are you going to be doing the 1031? Right, ask them that question. Put it on the table. They're going to answer one of three ways every single time. Yes, we are. No, we're not. Or, what is that? Right? Yeah, right? What is that? Doesn't matter how they answer. Say, you know what? I'll have my 1031 guru give you a call, answer all the questions for you, let you know your options. But some of them will say this. Some will absolutely say this. They will say, no, we're not going to do an exchange because I've calculated the tax in my own mind and it's not that much. There's two glaring red flags in that statement. What is one? Thank you very much. Yep, I calculated my own mind. I work with clients all the time that have owned real estate for 20 or 30 years, and they're selling for the first time because they buy and hold, right? If you haven't sold real estate in 20 years, you're not familiar with taxation, right? You're not. A lot of people think, well, I'm just going to pay 15% in taxes because that's what they've heard capital gains is, right? Let me be very clear. It's physically impossible to pay 15% in taxes when you sell investment properties anywhere in the United States, even if it's a state that doesn't have state tax, which Idaho ain't one of those states. The average tax ends up being about 30%. Just to tell you kind of the levels of taxation, here's the various levels of taxation. And by the way, you don't have to take pictures of these. If you want these slides, just call me, email me, and I will send you the copy of the slide deck as well. So there's 3 layers of taxation in real estate, investment real estate. The most common one that everybody knows about is capital gain. Right? Capital gain is a tax that is taxed on the appreciation of an asset. right? You bought it for $550, you sold it for $750. That $200,000 is gain, that appreciation, right? That is taxed to the federal government between 15 and 20%. Whether you pay 15 or 20 depends on the adjusted gross income of that taxpayer, right? That's the feds. Who else wants a chunk? The great state of Idaho. They want a chunk as well. So you're looking at, roughly 5.6%, somewhere in there, that neighborhood. So you're looking at between 20 and 25% in capital gains tax, just on the appreciation, right? So you've already blown way past 15%. Now the other tax, I call it the hidden tax because you're only familiar with this tax if you've sold a property and actually been hit by it before. It's called recapture of depreciation, right? You all know about depreciation. It's one of the major benefits in owning real estate that's improved, like a rental property. Like if you buy a rental property for $550,000, you get to take the value of the improvements, which on average is maybe like 75% of the purchase price. You got to take that big number and divide it over 27.5 years. And then that becomes a write-off each of those 27 years. So for that size property, I don't know, you're probably looking at about $10,000 in depreciation each year. So after every year you take depreciation, you have actually no, that'd be $15,000 probably. So $15,000 of depreciation. So what happens is you now automatically get this $15,000 write-off every year. So the first $15,000 of income that comes off the property, you don't have to pay income tax on because you've got this write-off. It's a wonderful thing. But every year you're taking the depreciation, you're lowering your cost basis in that property. Right, so if you take $15,000 a year and you've owned it for 10 years, you've taken $150,000 of depreciation. So after 10 years, if you bought it for $550, that ain't your basis. After 10 years, your basis is $400, right? So you sold it for $750. That's taxed as capital gain. The $150 of depreciation that you've taken is also taxed. It's taxed separately from the gain, and it's taxed at a higher, more punitive rate. That's a flat rate of 25% no matter what your income tax bracket is. And in the state doesn't care if it's appreciation or depreciation, it's just taxable income to Idaho, so it's the same 5.6. So, there you're looking at roughly 30% in tax on the depreciation recapture. Final tax is also a little known one. It's called the net investment income tax, more commonly known as the affordable health care tax. And that one is 3.8% on top of everything we just talked about. Right, so you can see it is impossible to pay 15%. In most cases, it's going to be closer to double that. So let's run a little math scenario here. So by a show of hands, who here was my math major in college? No, nobody ever raises their hand for that. What is your name?
Engineering, but yeah, Todd Simonson.
Todd, pleasure, Todd. Thank you. Thank you for volunteering. So Todd, you are now my agent. Look happy. Oh, there you go. You're a good liar. So yeah, so now I want you to listen to sell my property. I don't like that area anymore. My primary financial objective in life is still appreciation. I think that area is capped out for a while. I have found another area I think is going to go crazy over the next 10 years. I want you to listen to sell my $1 million property and then help me find and buy 3 bigger and better properties in this other area. I'm going after appreciation, so I'm going to buy as much real estate as I possibly can. I'm going to leverage myself out. So the money coming out of my sale is going to be a 25% down payment on a 75% loan to value ratio, okay? So let's say my average tax is 30%. So I'm not doing an exchange. So when I sell, I'm going to have to set aside 30% to pay my tax. Todd, that's the big question. What is 30% of $1 million? Give him a round of applause. Math under pressure in front of all his peers. Yes, $300,000. That's $300,000 that I just said goodbye to, right? That will never earn another penny of income for me for the rest of my life. It will not grow and appreciate, right? Compound that number out between now and when I pass. That might be $1 million that won't be part of my portfolio, right? Because I paid my tax today. So that leaves me $700,000. So with $700,000 as my down payment, I can buy 2.8 if I leverage myself out. So that's nice. Sold for $1 million, bought for 2.8. Now, let's do the 1031. So I walk into your office and say, I want you to list and sell, help me find and buy. You say, Russell, have you heard of A?
31.
I say, no, I haven't. So you put me in contact with who?
Russell.
Yes. I talk myself into the exchange. I do an exchange. How much do I have to set aside in taxes? big duck egg, right? Goose egg, 0. How much do I have as my down payment? A full $1 million. With the same loan to value ratios, I can buy $4 million, right? Obviously, this is an exaggerated example, right? But I can buy $4 million instead of 2.8 simply because I did a 1031. So this is an exaggerated example, but no matter what the scenario is, there's always a big difference, right? And this is just one transaction. Multiply this out over all of the buying and selling I will do over the course of my entire life. You'll see how much larger my portfolio is because I didn't pay my taxes. I went. Even, yes?
How's your depreciation start at $4 million now once you exchange into those 3 properties that you bought?
Great question. So in a 1031 exchange, you're deferring the tax, right? You're not eliminating it. So the tax you're deferring is going from the relinquished property you sell into the replacement property that you buy. Let me give you an example. I'm going to make the math easy for me. Let's say I buy a property for $100,000. I sell it 10 years later for $200,000. I do a 1031 exchange, and I buy something equal or greater for $200,000, right? Even though I just bought this property for $200,000, that's not my basis. My basis followed me, right? My basis is the old $100,000 that I brought there, and I've owned it for 10 years, so I've taken 10 years of depreciation. I have 17 years left, right? Now let's change the scenario. This is more common. I bought for $100,000 originally. I sold it for $200,000 after 10 years. I did a 1031, but I didn't buy for $200,000. I bought for $300,000. I bought up in value, right? My exchange requirements were satisfied at the $200,000. So that excess amount that I bought is brand new basis with a brand new depreciation schedule. So that resets. So it's kind of weird because I have one property, but I have 2 depreciation schedules on one property, right? But the only way to get new depreciation is to be buying up in value, right? Yeah.
So does it eliminate the prior?
Not at all. Not at all.
It just carries forward.
Carries forward. Yeah, so now I just bought this rental property for $300,000. I've still, on the first $200,000 basis in that property, I've got 17 years left of depreciation on the old schedule, right? And then now I've got a brand new 100,000, that's got 27 and a half years. So I'm running 2 schedules for one property on my tax returns. Sounds complicated. It's not. CPA takes care of it in the year of exchange, and then it's just the same thing every single year for all the years you own it. So it's not as complicated as it sounds. It's all good. Now, even with this knowledge, still some people say, no, I don't want to do an exchange, right? And I got this a lot before the election last year. A lot of CPAs were telling their clients, don't do an exchange, just pay your tax. And the reason was because, I don't know if you remember during the election cycle, there was a lot of talk of capital gains going way up, right? And there was a high probability of that. And so it's like, well, pay it now while it's low before it goes high in the future. And the thought process, in a 1031, you're not eliminating the tax, you're deferring the tax, right? You're kicking the can right down the road, right? So they tell the clients, well, just pay your tax. And the thought process is, well, you have to pay it sooner or later. And of course, everybody believes that because everybody in this room, myself included, your clients, everybody, we all have been patterned our entire lives to believe that there are 2 things in life that are inevitable. What are those 2 things? Yeah, it's like you practice that. Yeah, death and taxes. We've been lied to. Only one of those is actually inevitable. Which one? We haven't got that one figured out. Yes, we do have the tax.
I have a question, and this is you can cover it later, but if you're buying properties in a self-directed Roth vehicle, you don't pay taxes. You've already paid your taxes on the front, so there's no reason to do a 1031 in that. You
don't do a 1031 with an IRA if an asset's in an IRA because that's the vehicle. That's the tax deferral vehicle, not the 1031, right? Yeah. So it'd be one or the other. So some people say, I don't want to do an exchange because, hey, taxes are inevitable. Not true. Taxes are not inevitable. Current estate tax law is crazy favorable. Right now, the estate tax, the floor on the estate tax is $14.99 million. Let's call it 15. 15, if you're single and your estate's below $15 million, no estate tax. If you're married, double that amount, $30 million. No estate tax. And your heirs get a step up in basis. The step up in basis is actually the super cool part. Let's say I bought a property in Meridian 60 years ago for 100 grand. When I pass away, it's worth 1.5, right? If I would have sold it in my life, that's 1.4 in gain I would have paid taxes on. Ouch. My kids don't have that. My kids, when they go on title the property after I pass away, the basis for them is stepped up to the fair market value as of the date of my passing. So let's say I pass away yesterday, which makes this class kind of awkward. So I passed away yesterday. My kids go on title the property today. They can call you, Todd, and say, hey, we want you to listen to sell Pop's old property. We don't want it. They don't need to do an exchange. They have zero tax consequence because they're selling it for 1.5. But guess what? Their basis is 1.5. It's like they bought it yesterday and they're selling it today. There's no profit there. There's no gain there, right? So they don't have to buy other real estate with those proceeds. They can do whatever they want with those proceeds. So that's why I say don't let your clients cash out of real estate and give up that 35% or 30%. Instead, just help them exchange into something else. I promise you, whatever their financial objectives are, there's a type of real estate out there that will absolutely 100% meet those objectives. So don't let them cash out. Instead, help them exchange until they die. Yes, until they die. You said that with vigor. We call it swap until you drop. Very cool. That should be a bumper sticker. If your clients ask you what's the best way to avoid paying taxes, tell them to what? No, tell them to die. Yeah, just say die. Your kids will love you for it. Run into the light.
The benefit to taking the depreciation on your taxes, and because if you just hold on, if you keep rebuying, you never really pay that. Then
you will never pay the tax, the depreciation recapture, or the gain if you continue to exchange. Right? Just reposition to another asset because later on in life you want more cash flow. Great, go into because this property you have is not good for cash flow. Great, go into one that is. You want one passive? Great, go into one that's passive, right? There's always assets that are out there available that will suit your current financial objectives, and we'll talk about what those are. So any questions about estate tax or taxation in general? No? Very cool. Let's talk some basic numbers in 1031. Some of the basic rules of 1031. Time frames. You have time frames in a 1031. You have 45 days to identify, 180 days to close. Both of those time periods begin at the close of escrow of the relinquished property. Right? That's the only thing that starts the clock. It's not opening escrow, it's not going into contract, it's the actual physical closing. If you need more time, postpone the closing of the relinquished property. Postpone the clock from starting. Because once it starts, it can't be stopped. And those are calendar days. They're not business days. So if one of those deadlines falls on a weekend or a holiday, it's still that day, right? You don't get the next business day. Now, when do we have to open the exchange by? What do you guys think?
You have to open these.
You were about to say it.
So don't you have to open the exchange prior to close?
100%.
The fiduciary.
Yep. Yeah, so it does. So because I get this phone call, we have to open the exchange before the relinquished property closes. I get this phone call literally every week. A client will call me and say, hey, Russell, my realtor said to give you a call. I need to set up an exchange. Great. Where's your escrow at? So we can set it up. Oh, it closed last week. My realtor said it'd be easier to do the exchange after it closed. Yeah, even though I'd never say this to the client, but I'm thinking in my mind that realtor is about to be known as defendant because they gave some bad advice that's going to cost their client some tax hits. We have to be in place before closing. We can't open an exchange until they've accepted an offer from a buyer and they've opened escrow. Right? And then we just have to set it up sometime during that escrow period before it closes. That's when we officially open the exchange. When should I first be talking to your client? Way in advance, right? As soon as you have the first conversation with your client, right? I don't care if they're selling 5 years from now. The sooner I talk to them, the better. It's daunting from their perspective, right? They're selling an investment property. They're worried about IRS code. They're worried about time frames. They're worried about paying their tax. It can be super stressful. My job is to make sure they go into this transaction 100% stress-free and keep them on track, make sure that they know what their priorities are for the 1031. So the sooner I talk to them, the better. I can talk to them 10, 15, 20 times, right, before they ever get into contract. Talk to their tax advisors as well, right? But we don't open the exchange until they're in escrow. It can be the day before, the day of sometimes. We call it a rush, when that happens. We like to have time, right, at the beginning of the exchange to set it up as opposed to at the end, but either way it works. But it has to be in place before closing. The 45-day identification rule is the #1 killer of 1031s. It is. Because what happens is people wait, they procrastinate. Don't let your clients do this. They'll say, you know what, I don't want to write offers on a replacement property until my relinquished property is closed because I don't want to write a contingent offer. Fine, if you want to do that, it's dangerous. You should be in contract on your replacement property before the relinquished property closes, before that clock has started. In a perfect world, you want to try to complete the exchange before day 45 even passes. The reason why I stress that is because prior to midnight on day 45, you can change your identification all you want. You can add and revoke to your heart's content. But as soon as midnight strikes on day 45, you're set in stone on only buying something you've identified. You can't substitute new properties after day 45. Even if all the properties you named are no longer for sale. Doesn't matter. The IRS is very strict and rigid in their rules, right? So you can identify more properties than you actually want to buy, right? There's a couple rules of identification that you see behind me. The 3 property rule is the most common one, and that's where clients are, if most clients are buying 1 or 2 properties in their exchange, that's it. So those 3 property rule works well because they can identify up to 3 properties, and that will give them 1 or 2 backup properties that they can default to after day 45 if they need to. Some people go into an exchange knowing they're going to buy 4 or 5 properties or more because they're selling an expensive property, they're buying a bunch of smaller properties. Common, right? Well, you can't use 3 property rule, it doesn't work. So then the other common one is the 200% rule. That one, there's no cap on the number of properties. You can identify 10, 20, 30, 100, but there is a cap on the value. Everything you identify can't exceed 200% of the value of the real estate you sold. You sold a $2 million property, you can identify $4 million worth of replacement properties, no matter how many properties that consists of, right? One of those 2 rules will work for every single one of your clients. There's a 3rd rule, the 95% exception rule. I'll tell it to you, but I want you to forget it. You'll never see it used. In my 29 years in this industry, I've seen it used twice. It's where your client is like a rebel. Anybody have rebel clients? Yeah. It's like they're like, I will not be caged by your rules. So I'm going to identify 4 properties, therefore violating the 3 property rule. And those 4 properties are worth 400% of what I sold for. Okay, I can't use either one of those rules. Right? So then I have to default to the 95% exception rule. That one states you have to close on 95% of what you've identified. I don't know why I don't get the 5% thing, because if you identify 10 properties, how many do you have to close on? 10. All 10. If you close on 9, your entire exchange fails, right? So the 2 times I've seen it used were similar scenarios. It's where an exchanger was buying an entire portfolio of real estate from one seller. And that portfolio was more than 3 properties and more than 200%. And they were either going to buy that portfolio or nothing, right? So it's just kind of a catch-all. Don't worry about any of those rules. Because whatever rule best suits your client, I'm going to have this conversation with your client. And I'm going to help them to determine while they're in the exchange which one of these rules is best for them to use. Yes? That's the first person in Idaho I've ever heard that from.
So she just put her house on the market. So explain to me with your company, IPX,
yeah.
what's the difference between using you versus my title company's 1031 exchange officer? So what, like, would they do the same thing that you do, or do you do something different for the client?
So you mentioned the title company doing the exchange. Technically, the title company doesn't do the exchange. They have a QI, like us. They haven't qualified entry because escrow can't do the exchange for you, right? They're a neutral third party. We have to be a disinterested third party, right? So yes, somebody has to act as the qualified intermediary. And most title companies do have their own little, mom and pop QI, right? Well, something people don't know, and I wasn't going to cover this today, but what the heck you asked. What a lot of people don't know is our industry is unregulated by the federal government. 100% unregulated, which is shocking because are you guys regulated? Heavily. Is the title companies regulated? Heavily. Lenders, heavily, right? Us, no, 0. Who has title to your funds? We do. Escrow closes. They have to wire funds to us. We're holding your client's funds for up to 180 days, right? We have legal title to those funds. We can do whatever we wish with those funds. We can commingle. We can invest them in risky things to try to make money on it while we're holding the funds. Because of that, over a billion with a B, dollars have been lost because of QIs over the last 25 years, right? We've screamed for regulation from the federal government, and they have still said no. So it continues to be unregulated. So you have to be just careful who you're using. We're the largest QI in the nation by far. Our closest competitor is less than 50% of the volume we do nationwide. Our parent company is Fidelity National Financial. Same parent company that owns Fidelity, Chicago Tyco, our largest title insurer in the world, right? Fortune 300 company. They back us. They make us put into place the highest level of safety and security in the entire industry, right? So with us, your money and your clients are the safest. Plus, they have access to me, right, at all times. They can call my cell phone number and stuff. A lot of QIs are what I call lazy, because we can't, as a QI, I can't have an agency relationship with you or your client. I can't be their CPA, their attorney, right? So people lean on that. You'll ask your QI a question, they're like, talk to your CPA. Like, no, I'm like, no, talk to me.
QI, what does that stand for?
Qualified intermediary. That's the formal term for what we do, who we are, right? Excellent. So get back on track here. So you have 45 days to identify, 180 days to close. Now, I said there's no extensions. Not 100% accurate. 9/11 was the first extension ever granted in 1031 because you couldn't close a loan for like a week, right? So Congress enacted a 120-day extension for all 1031 exchangers after 9/11. Since then, now the IRS issues these 120-day extensions for all federally declared disasters. Forest fires, floods, hurricanes, COVID. You know, these are all examples of 120 extensions. So if your client lives in an affected area that's named in one of these notices, it doesn't mean they evacuated, it doesn't mean they lost a property, it just means they live in one of the counties named, right? Then they get the extension no matter where their properties are. They could live here and a county here was named in it. That's where their primary is, but they're selling a property in Washington and buying one in Florida. Well, they get the exchange. Doesn't matter where the properties are, right? So, but very few people actually are able to take advantage of this because it's not something you can do proactively. Well, actually, I guess it is. I guess if you do need more time, what could you do? No, you could like create a federally declared disaster. Just understand you're probably going to go to jail. You're going to go to jail, but you're probably going to save some money in taxes. So very cool.
It has to be where you're living, not where your properties are.
Well, it can. So I mean, think about this. It's not because your property. You haven't. If you lost your property or your property, that means you're not in the exchange yet because you haven't sold it, right? If you're buying, it does work. If you've identified properties and it's past the 45th day and that area and those properties you identified are destroyed because of this, then yes, that does work. But the majority of extensions are issued because it's where you live, not where a property is located.
And that extension is on that 45 identification.
Both 45 and 180, 120 extra days to identify, 120 extra days to close on top of those. So it is an advantage, right? So it might be worth going to jail for. I don't know. It's up to your client. Equal or greater value. So 3 things have to be equal or greater if you don't want to pay any tax. But let's ask this question. So if I sell for $1 million and I buy for $800,000, that's all I do is just buy for $800,000. By a show of hands, how many think I've failed my exchange? How many think I have a valid exchange? How many don't get? You had to raise one hand or the other. Perfect. Actually, you have a valid exchange. It's not failed. You've sheltered the $800,000. You're just going to pay tax on the difference, right? It's just the difference is going to be taxable. We call it taxable boot. Strange term, right, in our world, taxable boot. But any difference, if you buy down in value, it's just that difference is going to be taxable, right? So it's still okay. It's still that's what we call a partial exchange, right? But 3 things have to be equal or greater if you don't want to pay any tax. So the first thing is purchase price, right? If you sell for $800,000. You got to buy for close to $800,000, not quite $800,000, because there are some subtractions allowed. If you sell for $8,000, you do get to subtract the one-time traditional costs of sale, your commissions, title and escrow fees, transfer tax, our fee, right? That all comes off. So if you sold for $8,000, those costs were $50,000. $750 is the equal or greater mark you need to buy for to defer all tax, right? So if they're still going to pay like a little bit of tax because there's a delta there, what can you do to help them?
Take more commission.
There you go. Look at you, Todd. Pay more, charge them more in commission. You're a giver. Look at you, all generous. Let me help you. Help me help you. Yes, absolutely. Second thing that has to be equal or greater are the cash proceeds, right? So all the cash proceeds that come out of the closing, because they closed on the relinquished property, they paid off a loan, they paid commissions. What's left? That's the proceeds. All of the proceeds have to come into the exchange account, and all of the proceeds must be the down payment for whatever they're buying in the exchange. Any cash that goes directly back to them is going to be taxable. It's okay to do. People do it all the time. But just understand, if you touch any money, it's going to be taxable. Right? The third thing that has to be equal or greater is debt. This one, from a math standpoint, just kind of falls into place. So if you sold for $500,000, $250 was a mortgage that was paid off at closing. $250 are the proceeds. Okay, we're holding $250,000 for you, but you have to buy for $500,000 again in order to be equal or greater. But you only have $250 of cash to do that. So how are you going to buy something that expensive? Typically, you're going to take on a loan, right, to buy that property and replace the debt. Although there is an exception to that, as there always is, and that is you can replace debt with outside cash. So same scenario. If you sold for $500,000, $250 was a mortgage paid off. You got $250 in the exchange account. Well, if the exchanger has $250,000 sitting in a bank account somewhere, they can bring that in and buy their $500,000 equal or greater property all cash. Don't need to take on a loan. You replace debt with outside cash. Perfectly fine to do. Really, to simplify all this math, if two things happen, just keep your eye on these two things. If these two things happen, they will never pay tax. Buy and sell for equal or greater value, and do not touch any money. If those two things happen, there's not going to be any taxes paid in the exchange. Any questions on the equal or greater? No, let's talk about some cool stuff now. Now we're going to get past the rules and get into some good marketing concepts. Like kind. Who here has never been involved in a 1031 exchange yet? Raise your hands. Who also has not been to a 1031 class before? Excellent. Your name?
Lisa.
Lisa. Lisa, thank you for volunteering. So, Lisa, you've heard of a 1031 before today, I'm assuming. Have you heard this term, like kind? Yeah. Okay. In a 1031 exchange, you can buy and sell real estate. Defer all the tax. But the two properties that are involved in that exchange, the one you're selling and buying, they have to be like kind with one another. Okay. Who's Lisa? Lisa. So let's say you have 5 acres of bare ground, nothing on it. Right? You want to sell that bare ground, you'd like to buy this beautiful commercial building. Would you say those two are like kind? High five. You're 100% wrong. Thank you for playing. Yeah. You answered in total common sense. If I was not in my industry, I would answer exactly how you answered, right? Because that's just common sense. I'm a visual person. If you say it has to be like kind, I think if you sell land, you have to buy what? Land. Residential house for residential house, commercial for commercial, right? Not the case. All real estate's like kind with all real estate. It's not what a property looks like that makes it like kind. It's how it's treated for tax purposes. All business and investment properties are like kind. That's huge from a marketing standpoint. You should solicit raw landowners and let them know they can exchange out of raw land into improved property. And here's why. Lisa's 5 acres of land. Does she have any income coming off that? No. Yeah, maybe. It depends on what she's growing. We all know Lisa. Yeah. Yeah. Yes, she makes great brownies, by the way. Yeah. So no, has no income off it. Can't depreciate it because there's no improvements, right? It's a negative cash flow vehicle. You pay your property taxes on it. You pay to fireproof it every year to maintain it, right? It's outflow. There's no income coming off it. In the financial analysis world, it's what we call stagnant equity, right? The land's worth $400,000. That's $400,000, providing you zero income and zero depreciation. You need to solicit the Lisas of the world and say, I can help you list and sell that land, right? And help you exchange into an income property. You're going to buy your first rental property. Now you own an income property. You're going to have actual cash flow coming in off your equity. You're going to have depreciation to help shelter the income tax due from that asset. And in a lot of cases, you may have a better appreciating asset because maybe the house is going to appreciate long-term better than the land does. You did the entire transaction free using a 1031 exchange and the equity from the property you sold. People would be willing to do it if they simply knew the option exists. I promise you, most landowners like that have either never heard of an exchange, or they've been told by their trusted advisor, you can't exchange land for improved property. I can't count the number of times I've had tax advisors tell my clients, you can't exchange raw land for improved property. It's not like kind. 100% false. Never been true. Right? So that's a huge knowing the true power of like kind. And that's, if you look at all these different asset classes on the screen, they kind of all have different types of financial objectives. And that's the beauty of the 1031 and why it's so powerful from a wealth building standpoint, because as your objectives change, it allows you to pivot to that type of real estate that better suits your current and changing financial objectives, right? It's all like kind. But if it's all like kind, why even have that term like kind? Because there are some things that are not like kind. Some things you can't exchange into. Everything you see on this slide here, you cannot 1031 into, right? On the upper left-hand corner, you see partnership interests. A partnership can do an exchange. LLC, S Corp, C Corp, they can all do exchanges. Any tax-paying entity can do an exchange. But whatever taxpayer is selling has to be the same taxpayer that buys, right? If we are in a 3-member LLC together and you guys want to buy me out, why do you want to buy me out? You can be honest. Tired of me. Yep, you've been in an LLC with me before. Cool. Yeah, totally. Yeah. That's a familiar thing I get. My buyout is not exchangeable. It's a taxable event, right? Because you can't exchange into or out of a partnership interest, right? So if you have, and I bring this up because in the future, if you have clients that own properties, very common for multiple investors to be in one LLC that own investment properties, if they want to go their separate ways, what are you going to do? Call me. What's the most important thing you're learning today? My phone number. When can you call me? Anytime. Very cool. Yeah. Maybe. My wife might answer then. But she's conversationalist. It'd be fine. Inventory properties, stocks, bonds, notes, things like that. I have a picture of a saber-tooth tiger skull there because I actually did an exchange on a saber-tooth tiger skull. We used to be able to do exchanges on all kinds of personal property assets, not just real estate. The Jobs Act in 2017 changed it, right? Because you could, before 2017, you could exchange planes, boats, fleets of vehicles, arts and collectibles, livestock, right? All kinds of things you could exchange. Now it's just real estate.
Can I just ask, is that nationwide or is that state by state?
No, it's nationwide. 1031 is federal.
I debated a friend of mine, Rosie Wilcox. She's in Tennessee. She was telling me that we can exchange into boats. And I was like,
No, you can't.
just said
Not
the
anymore.
last 2 years ago. I'm like,
Not anymore.
No, you can't.
Not anymore.
Okay, so at one time it was.
What they did was they were 2017. They changed having to use a 1031 with what they call immediate expensing. So if you sold a boat that you had for business purposes, you fully depreciated it down to a zero basis, right? And so you're going to pay tax on whatever you sell it for as ordinary income. So if you buy another boat for business purposes in the same tax year, then you get to write off the 100% of the expense in that year. So therefore, it would negate the tax due, right? So 1031 was eliminated for it, but you have another benefit you can use. Real property, that doesn't work. So that's why they kept 1031 with real property. Yeah, but the saber-tooth tiger skull is an interesting story. That is a Montana client. She called me. She wanted to exchange her saber-tooth tiger skull for a mammoth skull. And she was simply calling me to ask me if they were like kind. And I said, well, the IRS has never created a comprehensive list. I believe they're like kind, but your CPA is going to have to write off on this that they agree it's like kind. So I said, hey, let's get on a conference call together. So we did. I'm on a conference call with the CPA, the client, and myself. About 5 minutes into my conversation, I'm explaining to the CPA why I believe it is like kind. She shuts me down. She's upset. Like, Russell, we need to stop this conversation right now. I'm like, whoa, what's wrong? You are putting my client in danger with what you're recommending. I said, whoa, what do you mean? She goes, I think what you're telling my client is illegal. I was like, whoa. And this verbatim, she said, I know for a fact that the saber-toothed tiger is on the endangered species list. It's like, no, it's the other list, extinct. Yeah, I think the EPA checked the box like, 11,000 years ago or something, right? That's when the last one died in the zoo. So I said, no, we're good, we're fine. So we kind of, even though I didn't make anything of it, I was thinking in my mind, you need a new CPA. Yeah. But there's one category here that it's very important for you guys to know about, and that's the primary residence, right? Primary is a personal use property, doesn't qualify 1031, right? Does not qualify 1031, which is fine. You already have section 121 of the Internal Revenue Code, which is that $250,000 and $500,000 capital gain exclusion on your primary. You can take that, by the way, every 2 years. You can sell a primary every 2 years and pay no tax. Because of that, that's fine. Nobody really wants to sell and do an exchange anyway on their primary. But what does happen is that people want to do the opposite, especially somebody of retirement age. They want to sell a couple investment properties. They like to use those proceeds to buy their dream home on the lake or in the mountains or in Hawaii, right? Well, it's a personal use property, can't do it. But the IRS created my favorite revenue procedure back in 2008. This is Revenue Procedure 2008-16. This is a safe harbor. It's the IRS telling us, here's a recipe. This is exactly what you have to do to use a 1031 exchange to buy your dream home. And they are okay with it. And that's why it's my favorite revenue procedure. I read this like every night before I go to bed. It gives me very happy dreams. Here's the revenue procedure. Sell your investment properties, buy your dream home with the exchange for the first 2 years. You have to treat the property, this is the time period, 2 years. For the first 2 years, you have to treat the property 2 ways. One is you have to limit your personal use to 2 weeks a year or less, or 10% of the rental history annually, whichever is a bigger number, right? So if you were renting it on Airbnb for 300 days a year, you can use it personally for 30 days a year. By the way, if I'm going there to work on the property, is that a personal use visit? No, it's a maintenance visit, right? So there's ways to use it for more than the 2 weeks a year, legally, within the tax code. But I just have to limit my personal use. Second thing I have to do is show income on it, but that's a really low standard. I only have to show 2 weeks per year of income on it. That's it. If this is a dream home scenario, typically what's the last thing you want in your dream home?
Renters.
Thank you. Yeah, tenants, exactly. So this is a way where, yeah, you can sell your investment properties you would have been killed in taxes on because you've owned them forever. Your basis is next to nothing. You have to pay any taxes. You can use all that cash to buy your very expensive dream home, and for the first 2 years, all you have to do is limit your personal use and find your buddy to rent it to for 2 weeks a year. That's all I got to do. I don't have to have it listed on Airbnb or VRBO. I just have to show 2 weeks a year of income on my taxes. After 2 years, guess what I got to do? Whatever I want, right? I can move into it as a primary. I can treat it as a pure second home or vacation home. I never have to rent it again after 2 years. My exchange is safe harbored, can't be challenged if I follow this simple recipe. So this is a question, same thing, when you're talking to your clients and you're vetting them for whatever their financial objectives are for their real estate going forward, ask them this question, right? In the next 2 years, are you thinking about moving to another primary? Maybe even relocating to another state, retiring, right? Or have you thought about buying a second home or vacation home anywhere in the United States? If the answer is yes to any of those questions, I can list and sell those properties for you right now. And we can accomplish that goal for you right now with the 1031.
Is there restrictions on selling it down the road if you're using the safe harbor?
Well, if you convert it to a personal use property, and then when you sell it, the last use was personal use, it no longer qualifies 1031, right? But if you get it to qualify for 121 as your home, then you're not going to eliminate all the tax, but you can eliminate some of the tax, right? You'll never be able to eliminate all the tax, but you can eliminate even a big portion of it. It's a prorated share, right, of it down the road when you do sell it, depending on how many years you own it. But you can eliminate some of the tax. So any questions on that wonderful thing? Now let's talk about mixed use exchanges. This is super important. Here's a question you should ask every single primary residence listing you are taking. Ask the sellers this question. Do you have any business use in this property? Ask them that question. They might say, well, what do you mean? Well, do you claim an in-home office? Because who's been doing that since COVID? A lot of your folks, right? Do you rent out a bedroom on Airbnb to traveling nurses, right? What do you do with that ADU in the backyard, right? All that stuff. If they have a business use in their primary residence, they're claiming depreciation on that portion. Let me be very clear. When you sell a primary residence, that capital gain exclusion of $500,000, that's an exclusion only on capital gain. It is not an exclusion of the recapture of depreciation. So any depreciation you've taken is absolutely going to be recaptured. And that's a minimum of 30%, right? So if they say, yes, we have an in-home office, next question is, go to your CPA, find out what your tax hit's gonna be when we close on this primary residence. CPA comes back and says you're going to pay $2,000 in taxes. No big deal. Just pay the tax. Don't do an exchange. CPA comes back and says you're going to pay $60,000 in taxes. You've been doing this forever. Okay. You need to do an exchange. You can do a mixed use exchange. Mixed use means it's one property, but it has multiple uses. Some personal use and some business use in the same property, right? The business use portion qualifies 1031. So how do we figure out that? That's pretty easy, actually. So this picture we see on the screen here is a duplex. I live in half, I rent out half, okay? Square footages are identical. Okay, half the sales price at closing comes to me tax-free as my home. The other half the sales price is that equal or greater mark we talked about that you have to buy investment properties for. Right, so you eliminated some tax, deferred the rest. If it's an in-home office, then well, how do we figure out that? It's square footage, right? You're depreciating a room as your office. That room is 15% of the total square footage of the house. So you're taking 15% depreciation. So 15% of the sales price needs to flow through a 1031. 85% of the sales price will come back to you at closing completely tax-free, right? We call them ADUs now, but we used to call them mother-in-law units. Oh, sorry, that's a typo. The mother-in-law unit in the backyard. Same thing, if it's detached, you're renting that out. What's the square footage of that versus the entire square footage of all the improvements, right? You need to do an exchange on that portion. Here's an interesting one. Primary on acreage. Let's say I bought a property outside of Meridian 60 years ago on 100 acres. A house. Never ranched it, never farmed it. The whole time I owned it. Just wanted to have big open land. 60 years ago, I don't know, maybe I paid $100,000. Right? Now I want to sell it. It's my primary residence. It's no longer in the country. Because guess what? Cities come to me. I'm next to a golf course. My property is subdividable for residential properties. How much is my 100 acres worth now? A lot. Let's just use 5 million, just pick a number. I bought it for 100,000. I'm going to sell it for 5 million. How good is my $500,000 exclusion? Not that good, right? I get my 100,000 basis back. That's never taxable. I get $500,000 of gain free. That's $600,000 I get tax free. I'm selling for 5. That's what, $4.4 million fully taxable. Ouch. I'll probably pay 1.7, 1.8 in taxes on that. It's a lot. It qualifies mixed use right now. Even though you never rented it, you never farmed it, you never ranched it, never produced an income. It doesn't need to be income producing. Land does not need to be income producing to qualify 1031. It just has to be held for business or investment purposes. If I hold raw land that provides me no income, I hold it for appreciation. That's investment, qualifies as like kind. So what you're going to come into play on this. You're going to do 2 separate brokers' opinion of value for them. They only use the house and the acre around it for personal use. So you need to show them what's that worth. If it were standalone by itself, what would that sell for? Maybe your comp say $1 million. And then, okay, now I want to know what's 99 acres of subdividable land worth. Well, maybe my comps show that's $4 million. Okay, great, now I've got my allocations. I'm going to tell escrow at closing, send me $1 million as my home primary residence exclusion. And then the $4 million, I'm going to allocate that into my exchange. We're going to send that to IPX, and then I'm going to buy $4 million worth of income properties that's going to provide me with income for the rest of my life. That's a minimum of $200,000 of income for the rest of my life on that. So didn't have to give up the 1.7, 1.8 in taxes. Right? Mixed use exchange. Only applicable if anytime your client is selling a primary residence and they're in excess of their $250,000 or $500,000, what are you going to do? Call me. What's the most important thing you're learning today? My phone number, when you can call me? Anytime. Okay. So, because there's other ways other than this to eliminate that tax with a 1031 exchange on a primary residence, potentially, right? So any questions on the mixed use? Cool. Let's, we're getting close to time. Let's talk about 1031s, other marketing opportunities. 1031 is federal. All states recognize the 1031, even the crazy state of California. They recognize the 1031. You can sell in any state, buy in any state. You will defer federal and state tax. People leave states for various reasons. I mean, we all know why everybody's leaving California, but other states like Idaho, people leave Idaho too, right? Not in those kind of numbers, not for the same reasons, but a lot of things, right? Okay, I'm retired and the winters are too cold. Someone moved to Arizona, or my kids moved to Alabama, so we want to be closer to the grandkids. There's all kinds of reasons. What I see, though, is people leave states personally. What I mean by that is they sold their primary residence in Meridian, and they bought a primary residence in Alabama. They still own investment properties here. My question to them is, why? And the reason is nobody's told them. You can 1031. You can sell your investment properties here and relocate them into Alabama where you now live, right? Nobody actually wants to manage from 2,000 miles away. They don't. It's just nobody's told them that. So it's a great marketing opportunity to solicit them. And the math works out 100% of the time. You can sell one property, one rental property in Meridian, and with those proceeds, you can buy like half of Alabama. You can own the whole Bama part, right? Very cool. So also, is it difficult to get contact information for people that own properties here but they live out of state? Super easy. Super easy. How do you do that? Thank you very much. Yeah. Same thing. Raw landowners. Super easy to get their contact information, right? Let's listen. On my website, which you've seen here, and I'll see at the end too, bookmark it, because there's a lot of tools for you to sign up for the newsletter. Phenomenal to share out, but also on social media. But also, I have created postcard templates for you guys if you want to use them, or just take the verbiage off and create your own piece or whatever. But all the solicitations we're talking about here, there's the tools to solicit those people on my website. So that's selling, moving markets. So this is the most common reason why people do 1031s, is diversification. I'm using the 1031 to build wealth. I bought one property. After 5 years, we have some sweat equity in it. So now let's sell it, do an exchange, and we'll use those proceeds to buy 2 properties or a bigger and better property, right? I'm going to play the game of kind of monopoly, and I'm going to build my wealth, right? That's the most common reason why people do exchanges. Now, the back end of this is the greatest solicitation opportunity for you guys right now, and will be for the next handful of years. Our world, I know the real estate world in general is kind of like me. Our world is crazy busy. There's a lot of exchange happening. Last year, a lot. Heavy volume. This year, more. Anybody want to guess the demographic that is driving that extra volume? What's the age group? The baby boomers. Baby boomers. Baby boomers are repositioning assets as they go through the various phases of retirement. Baby boomers make up only 20% of the population of the US. They own over 41% of the residential real estate in this country. That's huge. The numbers are more skewed than that. Because if you look at that 20% that is the baby boomers, a lot of them are married to each other. So, and you look at from just a taxpayer standpoint, like how many taxpayers own those properties? It's really probably 12, 13% of the population owns 41% of the residential real estate. Baby boomers, if somebody's a baby boomer and they own a rental property, they are in the absolute wrong asset class. They are. This isn't sales, this is math. This is financial analysis. And here's why. So let's say a retired 70-year-old couple own 6 properties, single-family rental properties, free and clear. Very common scenario, right? When they bought their first property, they were in their 20s or 30s. Friends told them, buy real estate, it's a good investment. So they did. They bought a fixer. After a couple of years, had some sweat equity in it, maybe some positive cash flow coming off it, and then they decide, hey, let's do this again. So they buy another one, and another one, and another one. So now they own 6. They've owned them forever. They own them free and clear, right? When they first started investing in real estate, they were young. So by default, what was their financial objective in life? Was it cash flow or appreciation? Appreciation. Thank you for saying cash flow, because that's super common, right? Cash flow, drives me crazy to see these like real estate infomercials. It's like cash flow, cash flow, cash flow. No, stop. That's not financial analysis, right? If you are young, if you're trying to build wealth, then by default, your objective in life should be appreciation. So you need to buy properties, if you're buying real estate, you need to buy properties that are going to primarily appreciate, that are going to double, triple in value during the time that you own them. So you build the most equity in the property. Cash flow is important. It's part of the analysis, because you have to make sure the property cash flows as much as you need to keep that property, which is different for everybody. Some people have to have positive cash flow because financially they can't keep the property. Some people are fine with a break even. Some people actually want a loss for tax purposes. No right or wrong to any of those. But single family, the primary financial objective of single family is appreciation, not cash flow. From a financial analysis standpoint, cash flow on single family is not good. It's not. It's at the bottom of the rung, or one of the bottom of the rungs in all of the financial, in all the assets in real estate, right? They're in the wrong asset class. They're in something designed for, but they don't know it because they're a retired teacher. They're a retired policeman. Financial analysis isn't their thing. They think their properties have done really well because they've tripled in value. Well, it did do well for you appreciation-wise. You bought the absolute right type of property to grow your wealth. But now, you're retired. By default, what is your financial objective in life now? Cash flow, 100% cash flow now, right? But they think their properties are cash flowing nicely. It's not. It's not. You are lucky. If you, single family, you're lucky if your single family rental property is cash flowing 3%. From the actual net income, gross income, subtract all expenses, including repairs, everything, right? Take that net income, divide that out by the value of the property, you're lucky to be getting 3%, right? So they're in the wrong asset class and they don't know it. And it's not even on their radar to sell. But they need to sell because they could double their cash flow. And another thing they could do is go passive. Because a lot of people that are retired, they want to go passive. They're like, I'm done with the headaches of real estate. It's killing me, So great, that's another objective. So commercial real estate is designed for cash flow. That's the cash flow asset in commercial, industrial, et cetera, right? Multifamily apartment complexes, things like that, right? That's cash flow. If you want to go passive, that's triple net lease commercial, right? The property, the tenants pay and do everything, right, in a triple net lease. I just receive income. But here's the daunting part of that, right? If you sit before this client and tell them you need to sell your rental properties so we can put you into commercial triple net lease, what is their response? They're like, what is that? Right? That sounds scary. We're very familiar with single family because we've had them for 3 decades. We're not familiar with what you're talking about. That sounds risky. And that's where DST comes into play. The Delaware Statutory Trust. If you don't know this acronym, you need to write this down, because this is a powerful listing tool for you all. The Delaware Statutory Trust. The DST is a form of replacement property in our world. This was formally approved by the IRS back in 2004, 21 years ago, as like-kind replacement property in the 1031 world. So we have 21 years of history of DSTs in our world, a lot of history. They were created to satisfy the niche of people that wanted to retire from active real estate and just wanted to go 100% passive. A Delaware Statutory Trust is the most passive form of real estate ownership. When you buy into a DST, you're buying a fractional ownership interest in an institutional-sized asset. So this is going to be $100, $150, $200 million Class A asset. It's going to be an Amazon distribution center. It's going to be a very large medical facility. It's going to be a climate-controlled mini storage, something like that, right? When you invest into a DST, you're 100% passive. As an owner in the property, you have 0 duties and responsibilities. You'll never receive phone calls. You'll never make any decisions. All you do is receive monthly cash flow that magically shows up in your bank account by direct deposit. So it's just cash flow. And there's no cash calls allowed, which means you can't be asked for any kind of maintenance costs. Like, hey, we need to replace the roof. We need 10 grand from everybody. Can't do it. There's no outflow, only income. It is the most passive form of real estate ownership. There's 3 reasons why people go into DSTs. Most common one is what we just talked about. I want to retire from active real estate. The second one is as a 1031 bailout. Right, your client couldn't find something in 45 days. They wrote offers, but just couldn't find anything. So right before day 45, they said, you know what, we're just going to pluck it into a DST. And then when it sells in 4, 5, 6 years, we'll come back out and buy traditional real estate again with another 1031, right? So to save your exchange at the end. Because there's always inventory. There's always between 30 to 50 different DSTs that are open and available. 5-day close, super easy to get into. The third reason why people use them is as a 1031 sponge. What I mean by that is your client sold for $2 million. They found traditional real estate for 1.7. What are they going to do with the other 3? Well, they don't want to pay taxes on it. They don't want to buy another piece of real estate with it. Great, pluck it into a DST. right? Because $100,000 is the minimum to go into a DST. So you know it'll absorb exactly how much you need from an exchange standpoint. And we talked about depreciation earlier and getting more depreciation. This is a great solicitation for somebody of retirement age that has owned their rental properties for more than 27 years because they have fully depreciated, right? And now they're paying a ton of money in taxes. Well, when you buy into a DST, most DSTs are leveraged by 50%. So if you're bringing in $500,000 of cash, because you're selling your property, you get it free and clear, and you're buying actually $1 million slice. So you're getting $500,000 of brand new depreciation. You're welcome with the DST. So it solves so many problems. It's a great listing tool for you guys. There are people, I'm telling you, there are baby boomers out there sitting on multiple single family properties. It's not even on their radar to sell because they think they have to buy another rental property and it's daunting to them, right? They don't know about this DST. When you go before them and say, hey, here's this DST, they're like, oh, the answer to our prayers. Please list and sell our properties and point us in the direction of these DSTs, right? So any questions on those?
What type of returns do the DSTs yield?
They're regulated by the SEC, the sale of them. So they're sold through financial wealth advisors. So they'll quote you two different types of returns. One is the cash flow. It's cash on cash, which is my favorite analysis number. That's whatever cash you're putting in. Cash on cash is a net income number after all expenses. The cash on cash net income averages between like 4.5 to 6, and most of these, so you got to pick and choose which one you like best. You know, there's ones that are higher, like oil and gas leases could be 8 or 9%, but you got to kind of pick and choose. They also quote you the IRR, the internal rate of return, because the asset's going to sell in 5, 6, 7 years. When it sells, you also get the appreciation. So maybe it earned 5% cash flow a year, but it appreciated 6% each year. So your total IRR was 11, right? They quote you both of those things. Yeah, pretty cool. So any questions on that? No, any questions at all? Is anybody still awake? If you want to do me a massive favor, if you can put your camera on this little QR code, the one on the right preferably. It's a Google My Business review. If you can do a little 5-star review in there, use some cool terms like, I don't know, ninja, if you can, kind of, or like genius, I don't know, whatever. I'll give you plenty of terms to use in there, if you like. But also I will stay and answer any questions you have here. What's the most important thing you learned today?
Phone number.
When can you call me? Anytime. Very cool. And talk to management about doing the evening class. I'd love to come back and do an evening class for your clients. They're a lot of fun.